Inflation is easing. That's what the headlines say. Charts are flattening. Percentages are coming down. Officials tell you the worst is behind us. But real life tells a different story. Rent renewals feel heavier than ever. Insurance bills rise without explanation. Grocery trips cost more even when you buy less. And every month, your paycheck feels like it's falling behind something you can't quite see. That disconnect isn't emotional, and it isn't a failure to budget better. It's structural. Inflation doesn't rise evenly. It never has. It concentrates in specific places, places you can't delay, can't substitute, and can't opt out of. When prices rise in those areas, the official numbers can calm down while your financial pressure keeps building. That's why inflation can be cooling and still feel worse than ever at the same time. Today, we're going to break down why that happens by focusing on three prices. Not the loud ones that grab headlines, but the quiet ones that quietly drain your monthly cash flow. These prices don't lie because they're fake. They lie because they distort how inflation is experienced in real life. Once you understand where inflation actually hides, the confusion disappears. And when confusion disappears, control starts to come back. To understand why inflation feels different from what the numbers say, you first have to understand what inflation actually measures. Inflation isn't your cost of living. It's an average. Official inflation is calculated by tracking the prices of hundreds of goods and services and combining them into a single number. Each item is given a weight based on how much the average household is assumed to spend on it. When prices rise in some areas and fall in others, those changes are blended together. That blending is the problem. Averages are designed to smooth volatility. They reduce extremes. They make chaotic systems easier to manage and easier to communicate. But smoothing also hides pressure, especially when that pressure is uneven. If the price of a television falls while the price of rent rises, the average can look stable even though your monthly budget is under strain. If airline tickets get cheaper but insurance gets more expensive, the data shows relief while your fixed expenses quietly expand. Inflation statistics don't ask whether a price increase is avoidable. They don't ask whether you can delay it. They don't ask whether you have leverage. They simply measure movement. And that means inflation can look under control at the same time your financial reality becomes tighter. The system isn't measuring stress, it's measuring balance. And balance, by design, can mask where inflation actually hurts. So here's the core idea. Inflation isn't evenly distributed. It never has been. The world doesn't get more expensive in one smooth wave. It gets more expensive in layers. And the layers that matter most are the ones you can't escape. Because there are two kinds of prices. There are optional prices, the ones you can postpone, downgrade, replace, or ignore. If your phone is too expensive, you keep the old one. If vacations cost more, you travel less. If a new TV gets pricier, you wait. These prices can move without destroying your monthly budget because you have choices. And then there are unavoidable prices, the ones tied to survival and participation in modern life. You don't negotiate with them. You don't shop around in a meaningful way. You don't opt out without consequences. These prices hit you every month, whether the economy is booming or collapsing. And when they rise, inflation stops being a statistic and becomes a condition. That's why inflation can feel worse even when the official rate is falling. The average might be cooling because optional prices stabilized. But if unavoidable prices keep climbing, your life gets tighter anyway. So today we're focusing on three specific prices, three categories that distort your experience of inflation because they control your cash flow and they punish delay. When these three move, you feel it immediately. When they move together, it feels like the system is closing in. And once you see them clearly, you'll understand why the inflation you live through rarely matches the inflation you're shown. The first price is the most obvious and the most dangerous. Housing. Housing isn't just another line item. It's the foundation everything else is built on. You can cut spending in other areas, but you can't pause shelter, you can't delay it, and you can't meaningfully substitute it without changing your entire life. That's what makes housing inflation different. When housing costs rise, consumers have almost no leverage. Rent renewals arrive on fixed schedules. Mortgage payments are locked in. Moving isn't free, downsizing isn't always possible, and in many cities, alternatives simply don't exist at scale. The market knows this. That's why housing behaves less like a competitive good and more like a toll. For most households, housing consumes the largest share of monthly income. 30% is considered healthy. For many, it's far more. But in official inflation measures, housing's impact is spread out, lagged, and averaged. The increases are real, but the pain arrives slowly on paper, even as it hits immediately in real life. When housing rises faster than wages, inflation stops being something you notice at the store and starts being something you feel every month. It reduces flexibility, it compresses choices, and it quietly forces trade-offs elsewhere in your budget. That's why housing inflation doesn't just raise costs, it reshapes behavior. And once it's in place, it rarely reverses. Rent doesn't fall easily. Mortgage burdens don't shrink on their own. Housing inflation becomes permanent pressure. This is what structural inflation looks like. Not a spike, not a headline, a new floor. The second price doesn't just rise on its own, it spreads. Insurance. Insurance inflation is quiet, technical, and deeply underestimated. Health insurance, auto insurance, home insurance, these aren't optional protections anymore. They're requirements for participation in modern life. You don't buy them because you want to. You buy them because the system demands them. And when insurance prices rise, they don't behave like normal inflation. They reset your baseline. Premiums go up, deductibles rise with them. Coverage narrows. What used to be protected becomes conditional. You pay more every month, and when something actually happens, you pay again. This isn't a one-time increase. It compounds. Once insurance costs rise, they rarely come back down in real terms. But the real impact goes further. Insurance inflation feeds directly into other prices. Higher insurance costs raise healthcare bills, repair costs, transportation costs, and business operating expenses. Those costs are passed forward to consumers, to workers, to prices you don't immediately associate with insurance at all. That's why insurance inflation barely makes headlines, but quietly accelerates everything else. Official inflation data treats insurance as just another service. But in reality, it functions like friction in the entire system. Every transaction becomes more expensive because risk itself has become more expensive. This is inflation that doesn't shock you once. It tightens slowly. And by the time you notice it, it's already embedded everywhere. The third price is different from the first two. It doesn't just affect your budget, it affects how you perceive reality. Food. But not all food prices. Specific ones. Every household has a short list of prices it remembers instinctively. Eggs, milk, bread, rice, cooking oil. These aren't luxuries, they're anchors. You don't check the price history of electronics in your head. You check these. That's why food inflation hits psychologically faster than almost anything else. When these anchor prices rise, trust breaks. Even if other food becomes cheaper, even if sales appear elsewhere, your brain doesn't register relief. It registers loss. You remember what these items used to cost, and every increase feels like proof that something is wrong. Governments understand this. That's why food prices have historically triggered unrest faster than taxes, faster than unemployment, faster than interest rates. When staple prices move, people don't argue statistics. They react. And here's what makes this deceptive. Food inflation can stabilize on paper while still feeling worse in real life. Package sizes shrink, quality changes, substitutions are pushed. You technically pay the same, but receive less. The price doesn't always move. The value does. Official inflation tracks prices, not trust. And trust is what actually determines how inflation feels. When people stop trusting everyday prices, inflation stops being abstract. It becomes personal. And once that happens, no chart can undo it. At this point, it's tempting to treat inflation like a failure, a mistake, a miscalculation, or even a deception. But what's happening here isn't accidental. It's structural. Inflation metrics were never designed to reflect lived experience. They were designed to support decision-making at the institutional level. Central banks need stable indicators to set interest rates. Governments need comparable numbers to plan budgets. Markets need signals that are smooth enough to price risk. That requires averages. Averages reduce volatility. They prevent overreaction. They keep the system functional. But in doing so, they prioritize stability over accuracy at the individual level. The goal isn't to capture how inflation feels. The goal is to keep the system predictable. That's why unavoidable prices don't receive special treatment. Housing, insurance, and food anchors aren't weighted by stress or necessity. They're weighted statistically, and statistics don't ask whether you can opt out. So when pressure concentrates in non-optional areas, the system doesn't flag it as an emergency. It registers it as imbalance that can be offset elsewhere. Falling prices in optional categories smooth rising pressure in essential ones. The system isn't lying to you on purpose. It's doing exactly what it was built to do. But what it was built to do isn't tell you how expensive life has become. It's tell institutions whether the machine can keep running. So what do you do with this? First, stop treating headline inflation like your personal reality. The national number is a signal for policy, not a report card for your life. If you want clarity, measure your own inflation. Track the categories you actually pay every month, not what an average household is assumed to buy. Second, focus on cash flow, not percentages. A small increase in an unavoidable bill can hurt more than a large increase in something optional. That's why managing inflation is often less about chasing discounts and more about controlling fixed costs, the expenses that hit on schedule and don't ask permission. Third, understand what the three prices are doing before you make decisions. Housing pressure changes everything because it reduces flexibility. Insurance pressure spreads because it raises costs across the system. Food anchors matter because they shape trust. And when trust breaks, people make worse financial choices out of fear. This isn't about panic. It's about precision. When you understand where inflation concentrates, you stop feeling confused by the charts. You stop expecting relief from numbers that were never measuring your stress in the first place. And you start making decisions based on what's real, the costs you can't avoid, the bills that keep coming, and the pressure points that actually control your month. Inflation isn't just an economic number. It's a cash flow environment. So yes, inflation can be cooling and still feel worse than ever. Because the inflation you experience isn't an average, it's a pattern. And the pattern is simple. When prices rise in places you can't escape, life gets tighter even if the official number improves. Housing is structural. Insurance is compounding. Food anchors are psychological. Those three don't just increase costs, they change behavior. They reduce choices. They break trust. And that's why the gap between headlines and real life keeps growing. Once you understand that, inflation stops feeling mysterious. The confusion disappears. And when confusion disappears, you stop making decisions in the dark. If this helped you see the system more clearly, subscribe, because this channel isn't about trends, it's about the structure underneath them. And if you want to take this deeper, the next question is the one that really matters. If inflation is concentrated where you can't escape, then who benefits from building an economy that way?